Every single day, the financial markets just throw this wall of numbers at us. But what do they actually mean? Today, we're going to cut through all that noise from August 21st and really uncover the story hiding behind the data. So let's get into it.
So let's start with a big one. This right here, this is the year-to-date performance of the S&P 500. We're talking almost 15% growth. Now, on the surface, that looks fantastic, right? A clear sign of a booming market. But is that what's really happening?
Because that one number, as big as it is, can't possibly tell the whole story. You gotta ask, is this optimism everywhere? Is every single part of the economy firing on all cylinders? That's what we're here to figure out. It's time to look under the hood. All right, so let's start with the highest level view. Think of these as the vital signs for the entire U.S. economy. These are the two metrics that pretty much everyone, from policymakers to investors, watches like a hawk.
Okay, so on the left, you've got GDP growth sitting at a very healthy 3%. That signals a robust, expanding economy. Things are looking good. But then, look over to the right. The unemployment rate is at 4.2%. Now, while that's not alarming, it tells us that even with all that strong growth, the labor market isn't quite at full steam. It's our first real clue that the picture is a little more complex.
So, from the overall economy, let's zoom into the stock market itself and see how this all plays out. I mean, if the market is up almost 15%, where exactly is that growth coming from? Is it spread out evenly, or do we have a few key areas doing all the heavy lifting?
Let's break this down. Tech is leading the way, which, let's be honest, isn't a huge surprise. But look at what's right on its heels. Energy, getting a big boost from tighter supply. And financials are doing well thanks to some stability in yields. The key takeaway here is that this isn't just a tech rally. The strength is actually pretty broad, coming from several key sectors.
But even within all that strength, there's this really fascinating split happening. On one side, you have hundreds of companies hitting 52-week highs. This is because of something called a rotation to quality. Investors are moving their money into big, stable companies they trust. But on the other side, you've got about 100 stocks, including some tech names, hitting 52-week lows, mostly because people are worried they're just too expensive. It's like the market is stepping on the gas and the brake at the exact same time.
And that cautiousness, that's a perfect lead-in to our next part. To really understand what investors are feeling, you have to look beyond just stocks. What are other assets telling us about the real sentiment out there? Is everybody really as confident as the S&P 500 suggests?
And this number, this is maybe our biggest clue yet. Over $3,300. That's the price for a single ounce of gold today. Just think about that for a second. In what looks like a strong rising stock market, why are so many people paying a premium for gold?
Well, it's because gold is the classic safe haven asset. People buy it when they're worried about the future, when they think there might be some turbulence ahead. So that really high price tells us that despite all the positive headlines, there are a lot of investors out there hedging their bets, getting ready for potential trouble down the road.
And you can see that mood reflected in other places too. The 10-year Treasury yield dipped a little bit, which is basically investors pausing and waiting for more data before they make any big moves. And crude oil is feeling some upward pressure, not from crazy demand, but from tighter supply. It all points to this undercurrent of uncertainty.
This brings us to the day itself, because all of this sentiment and all this performance, it's all shaped by real-time events and data releases. So what were investors glued to their screens for today?
The day was just packed. It started early with a Fed speech. Investors are always hunting for clues on interest rates there. Then at 8:30, we got the jobless claims numbers, a direct look at the labor market. And at 10 a.m., existing home sales data gave us a snapshot of the housing sector. Each one is another piece of the puzzle.
But maybe the biggest event of the day was corporate earnings, with a major spotlight on retail. And the key report everyone was waiting for? Walmart's. The estimated earnings per share number is a target, sure, but the real story is what it represents. A direct pulse check on the American consumer. Are people still spending freely? Walmart's results have the power to either confirm the market's optimism or validate its underlying fear.
So, if we had to boil down the entire day, the whole market mood, into just one sentence, this would be it. You've got strong, undeniable growth on one side, but on the other, there's a clear move towards safety, a hedge against a future that nobody is quite sure about. It's a fascinating contradiction.
And all that leaves us with the big question for tomorrow. We know Walmart's earnings give us a crucial piece of the puzzle about consumer health, but in a market this divided, will one good report be enough to finally tip the scales from caution to confidence? Well, that's the story to watch.